Welcome to the Deep Dive. Today we're digging into Public Square ticker PSQH. Their latest Q2 2025 earnings call, well, it definitely stirred things up.
It certainly did.
You had this unexpected earnings beat on one side,
Right.
but then this huge strategic pivot announcement that sent the stock down pretty sharply.
Yeah, a classic case of mixed signals, maybe.
Yeah.
The market reaction tells you a lot.
Absolutely. It feels like this big corporate change-up, this metamorphosis, could be seen as really bold or maybe, really risky. What's your initial take on where the real story lies?
Well, you nailed it. The headline numbers, they give you part of the picture, sure. But the real story, I think, is this massive strategic shift they've announced. It paints a much bigger and maybe more uncertain picture for their immediate future. It's less about just Q2 and more about this totally new direction.
Okay, let's start there then with the snapshot, the numbers that first hit the wires.
Sure.
So Public Square reported GAAP earnings per share, EPS, of negative $0.18 for Q2.
Right, a loss of 18 cents per share.
But that actually beat what analysts were expecting. So it's still a loss, but, less bad than predicted.
Correct.
However, the top line, the net revenue, that came in at $7.08 million. And that missed analyst expectations by quite a bit.
Yeah, and that's what's fascinating, isn't it? You get this EPS beat, which normally might give a little boost.
You'd think so.
But the market reaction was, well, decidedly cautious, almost negative.
So investors weren't just looking at that bottom line number.
Exactly. It tells us they were looking past the immediate figures and focusing much more on the bigger strategic picture, the announcements about the future, the guidance implications.
Right.
That all seemed to overshadow the EPS beat. It was like management presented the numbers and the market just said, okay, fine, but what's the real plan now?
Okay, so let's get into that plan. Let's peel back the layers on Q2 performance and this huge strategic pivot. What really jumps out when you look deeper at the financials?
Well, first off, net revenue was $7.1 million. That's actually up 18% year over year.
Okay, decent growth there.
Decent growth, yeah. But the real highlight, I think, was their Fintech segment. That pulled in $3.4 million.
Right.
And it would have been even higher, $3.8 million, which is a 28% year-over-year jump if it wasn't for a one-time vendor true-up payment.
Okay, so underlying growth was even stronger.
Exactly. And even more telling, the PSQ payments revenue specifically. That surged over 80% quarter over quarter, hit $1.0 million.
Wow, 80% quarter over quarter.
Yeah. I mean, that's not just a number. That feels like a big flashing sign pointing towards where they see the future.
Definitely signals momentum in that area.
Yeah.
What about the other parts of the business, the brands and marketplace?
So the brand segment, that's mostly their EveryLife brand. That earned $3.3 million. But the marketplace revenue was softer, only $0.3 million. But on the flip side, on expenses, they made some really substantial progress. Operating expenses dropped 41% year over year. That's significant.
41%. How'd they manage that?
Well, remember that reorganization they did late last year? They projected $11 million in annualized savings from that.
Right.
They've already realized about $9 million of that. Way ahead of schedule.
That's huge. Finding $9 million in savings ahead of plan, especially during a pivot, that's got to help.
Absolutely. And that cost discipline directly helped their bottom line. The JAP operating loss improved quite a bit, down to $8.1 million from $14 million in Q2 last year.
Okay, so losses narrowing significantly.
And the net loss per share improved too, from negative $0.36 last year to that negative $1.18 this quarter we mentioned.
Got it. But what about gross margin? I saw that decline down to 53% from 67% last year. That usually raises some questions.
It does. A lower gross margin means basically they're keeping less profit from each dollar of revenue.
Right.
Management attributed it primarily to, quote, changes in revenue mix.
Okay, what does that likely mean in practice here?
Well, it probably points to that faster growing fintech segment, which might, at least initially, have lower margins compared to, say, their established brands or maybe the marketplace revenue streams.
So it's kind of a trade-off, growing faster in a key area,
Yeah.
but maybe taking a temporary hit on the overall margin percentage.
Potentially, yeah. The hope would be that as that fintech segment scales up, the margins there improve over time. But right now, the mix shift pulls the average down.
Makes sense.
Ugh.
Okay, shifting to financial health, how are they looking in terms of cash and liquidity?
They seem pretty solid there. They had $20.6 million in cash and equivalents on hand.
Okay.
And they had $4.6 million drawn on a $10 million revolving credit line. So some borrowing room still available.
And they mentioned investments in money transmitter licenses.
Yeah, they spent about $455,000 moving forward with those MTL applications. That's a key piece for their fintech expansion, especially the payment side.
Right, critical infrastructure.
Definitely. And another interesting strategic decision, they decided to keep about $1 million in consumer finance receivables on their balance sheet.
Instead of selling them off.
Exactly. The idea is to capture more of the long-term return from those loans themselves rather than selling them quickly. It suggests confidence in their underwriting.
Ties into the risk management improvements we'll get to later, maybe.
Could very well do. And one more balance sheet item, that at the market, or ATM, offering.
Yeah, what was the story there?
They set one up back in May. They sold a relatively small number of shares, about 165,000, and the proceeds basically just covered the cost of setting up the ATM facility itself.
So not a major capital raise right now.
No, management framed it more as good corporate housekeeping. It just gives them the flexibility, the optionality to sell shares directly into the market down the road if needed without a big disruptive offering. It's about having options.
Got it. Okay, so the numbers show a company clearly in flux. Fintech growing fast, costs coming down, but maybe some margin pressure and softer spots elsewhere.
That sums it up pretty well.
But it's this next piece, the massive strategic pivot, that really caused the stir and hit the stock price. Can you walk us through the core of this shift?
Absolutely. This is the main event, really. Public Square announced a dramatic strategic repositioning. They're moving away from that multi-pronged model marketplace brands, fintech, to become a focused, purely fintech forward business.
All chips on fintech.
Pretty much.
Yeah.
They said the pivot is driven by just overwhelming demand they're seeing for their fintech offerings, the speed at which gross merchandise volume, or GMV, is building up there.
Right, the total value of stuff sold using their platform.
Exactly. And also the desire from merchants for their bundled checkout offering payments plus credit together.
They use some strong language, too, aiming for true greatness as a leader in financial tech. That's ambitious.
Very ambitious.
But, is there a risk here? Focusing so intensely on fintech, is that putting all their eggs in one basket? What's the pressure that puts on that single segment?
It's a fair point. It absolutely concentrates the risk. If fintech stumbles, there's less diversification to fall back on.
Right.
But management's bet is that this sharpened focus is precisely what's needed to unlock, quote, extraordinary growth and transformative shareholder value. The idea is stop spreading resources thin, pour everything into the area that's showing the most promise.
So how do they achieve that focus? What gets cut?
They plan to monetize the EveryLife brand through a strategic sale.
Sell it off completely.
Yes. And then either sell or strategically repurpose their marketplace intellectual property.
So essentially waving goodbye to significant parts of their current business to fuel the fintech engine.
Precisely. Starting in Q3, those segments, EveryLife and Marketplace, will be reported as discontinued operations.
Okay.
And they expect to have those deals done or the repurposing figured out by the end of Q4 this year.
And the goal of those sales?
To provide capital for the fintech business, specifically non-dilutive and tax-efficient capital, meaning cash that doesn't involve issuing more stock and hopefully minimizes the tax hit. It also, theoretically, lets EveryLife and Marketplace find new owners who might be better suited to help them thrive. The end game is to enter 2026 as a streamlined, pure fintech company.
All right, so that's the shedding part. What about the building part on the fintech side? Those money transmitter licenses, or MTLs, seem key.
Absolutely crucial. Pursuing those MTLs allows them to, 1, capture more margin on payments by handling more themselves, and 2, accelerate distribution.
And it ties into crypto, right?
Directly. This is a foundational step for them to develop crypto-based payment options, digital asset treasury solutions for merchants, things like that. It aligns with their stated goal of building, quote, cancel-proof infrastructure and promoting economic liberty.
Big vision. And they brought in new leadership to drive this.
Yes. 2 significant appointments. Caitlin Long, who's very well known in the cryptocurrency space, joined the board.
Okay, serious crypto expertise there.
Definitely. And James Wren joined as the new Chief Financial Officer, the CFO.
So beefing up the team for this fintech and crypto push, what about the existing fintech operations, like their credit business? Any improvements there?
Yes, and this is another, I think, really interesting point. They highlighted significant strengthening in their credit portfolio performance through much greater use of AI-driven underwriting. Their chief strategy officer, Dusty Wunderlich, talked about this. He said they started training AI models way back in 2021 using hundreds of data points from public records, credit bureaus.
Wow, so they've been working on this for a while.
Seems so. And the results. A remarkable 74.8% decrease in first payment default rates over the last 9 months, looking at it on a vintage monthly basis.
Nearly 75% reduction in early defaults. That's huge, especially given the broader economic environment for credit right now.
It's massive. It suggests their AI models are really effective at identifying risk, allowing them to outperform peers significantly in what's been a tough environment for lending.
For our listener, that means Public Square isn't just lending more, they seem to be lending smarter. That's a real competitive edge.
Absolutely. And that success, that improved risk management, is what's enabling them to make that decision we mentioned earlier to keep more of those consumer finance receivables on their own books.
Right, because they're more confident they'll get paid back.
Exactly. It feeds directly into potentially higher long-term returns.
Okay, let's talk about management's view. The CEO, Michael Seifer, talked about the mission-building commerce, protecting economic liberty. He sounded confident this pivot will unlock value.
Yes, very confident tone.
What else did they say about leadership and the board's role in all this?
They made a point of highlighting active board involvement. They mentioned specific members. Blake described as a tech whiz providing strategic guidance, Nick focusing on operations and, interestingly, faith-based community outreach, and Don Jr. contributing marketing know-how and deal flow, especially, they noted, in the firearms industry.
Interesting mix of expertise and focus areas.
And management strongly believes that their commitment to what they call their core values is actually a driver of profitability. They think it leads to better merchant onboarding and stronger customer loyalty within their specific target market.
Okay. And during the Q&A session on the call, what were some key takeaways?
A few things stood out. On getting payment customers onboarded, they admitted it's taken a bit longer than they first hoped.
Why is that?
Because apparently merchants are increasingly asking for that bundled offering, not just payments, but payments and credit together.
So a more complex integration.
Right. Requires a bigger technical lift, more work up front. But the flip side, management believes, is it will lead to more substantial revenue starting in the second half of this year.
Makes sense. What about the EveryLife sale? Any updates there?
They said the formal sale process has just kicked off. Early interest is apparently positive. They expect an accretive deal, meaning it should enhance the value per share for the remaining company. And they stressed wanting new ownership that aligns with the brand's values. The target is still to get it done by year end.
Okay. And crypto. Any more detail on their plans?
They mentioned recent SEC clarity, some legislative wins helping the space. Their goal, they said, is to productize crypto, make it a useful tool for commerce, not just a speculative asset.
Interesting distinction.
Yeah, and integrate it tightly into their fintech stack. They called it a potentially perfect marriage. They promised more details at their upcoming analyst and investor meeting in September.
Okay, so September is shaping up to be a key date for them to flesh out that vision.
Absolutely critical, I'd say.
So we've got the numbers, the massive strategic shift, the rationale. But how did the market actually digest all this news immediately following the call?
Well, the reaction was pretty swift and pretty clear. Public Square's stock price dropped sharply, about 14.6%, going from $1.98 down to $1.69.
Ouch.
Yeah, and on higher than usual trading volume, too.
So despite that EPS beat we talked about.
Despite the beat, despite the significant cost savings, the market sold off. It clearly indicates a very cautious, maybe even skeptical sentiment right now.
What were investors focusing on then, do you think?
It seems they primarily honed in on two things. The withdrawal of the full-year revenue guidance.
Right. Pulling guidance always creates uncertainty.
Always. And second, the plans to sell off major segments, EveryLife and Marketplace. Even though the goal is positive, the process introduces near-term unknowns about revenue, timing, deal value.
So that uncertainty basically just swamped the good news on cost control and the positive fintech KPIs.
It looks that way, yeah. And just for context for our listeners, PSQH stock has already significantly underperformed broader market benchmarks like the S&P 500 and even fintech-specific ETFs like the Global X Fintech ETF over the past year. So this drop came on top of existing underperformance.
Okay, that's a tough position. So looking ahead, what does this mean for you, the investor, trying to make sense of PSQH? Let's talk catalysts and risks. What could potentially turn sentiment around?
Okay, catalysts. First, concrete news on those asset sales, EveryLife and Marketplace. Getting those reported as discontinued operations in Q3, and especially announcing successful accretive deals by Q4 would be huge.
Removes uncertainty, brings in cash.
Exactly. Second, that upcoming September analyst and investor meeting is absolutely pivotal. They have to deliver a clear, compelling roadmap for the fintech and digital asset future. That's their chance to win back confidence.
What else?
Continued progress on getting those money transmitter licenses approved is key for execution, expanding their merchant pipeline for the bundled offering. And potentially, if they can simplify the business quickly through the divestitures, maybe they could reinstate some form of financial guidance sooner rather than later. That would help.
Any other positive developments?
Yes, actually a very significant one. The formal closure of that CFPB investigation into Credova, which is a core part of their fintech operation, back on August 19th. That removes a major regulatory cloud, a significant headline risk.
That is a big deal. Clearing regulatory hurdles is always positive. But okay, what about the flip side? What are the execution risks here?
Well, number one is that withdrawn guidance. Until they provide clarity, uncertainty remains a major overhang.
Right.
Number two, the crypto initiative. It's ambitious, but it comes with inherent risks, licensing challenges, compliance hurdles, getting partners and merchants to actually adopt these new solutions. It's not straightforward.
Execution is key.
Absolutely. And third, just the market's current focus. If investors remain fixated on the withdrawn guidance and the divestiture process, that cautious sentiment could linger until the company starts showing concrete positive results from this new, focused strategy. Proof points will be needed.
And zooming out, how does this fit into the broader industry?
We're definitely seeing trends like revenue mix shifts in payments and tighter consumer credit conditions impacting the alternative credit sector, which is relevant to PSQH's lending guide. The idea of merging crypto with traditional payments, like PSQH wants to do, that offers potentially very attractive margins if done right. But, again, it carries significant regulatory and execution risk, which is exactly why getting those MTLs is so critical for them.
Okay, that sets the stage nicely. Now let's move to our favorite segment where we toss around some, let's call them bold ideas. This is not financial advice, pitched with maybe a bit more nerve than you'd usually hear.
All right, let's get audacious. So look at Public Square right now, trading around $1.66 a SA share.
Yeah, reflecting that market skepticism we discussed.
Exactly. The market is clearly pricing in a lot of near-term uncertainty from this pivot, from the withdrawn guidance. And arguably, it might be overlooking some of the positives, those big operational improvements, the AI underwriting success, the clear long-term vision for a potentially high-margin-focused fintech business, and that Credova CFPB risk being removed.
So where's the audacious idea?
Okay, so here's a thought, purely speculative, of course, for someone with a high-risk tolerance and a longer time horizon.
Disclaimer noted.
Consider a highly speculative, long-dated call option position, maybe looking 18 months out, targeting a strike price, say, 50% to 75% above where the stock is trading right now.
Okay, so betting on a significant rebound, but giving it plenty of time.
Precisely. This isn't a short-term play. It's a bet that hinges on a couple of things happening. One, that September Analyst Day has to be a home run. They need to articulate a super clear, convincing path for this new fintech roadmap.
Right.
Two, the asset sales of EveryLife and Marketplace need to get done by Q4, and they need to bring in genuinely accretive, non-dilutive capital, paving the way for what management called a clean 2026.
So it's a bet on successful execution of the pivot and a re-rating by the market once the dust settles.
Exactly. And the Credova CFPB closure helps de-risk the core fintech engine, making that potential growth story more credible. This trade idea basically acknowledges the market's current doubts, but makes a heavy bet on management's ability to pull off this radical transformation now in a more focused and slightly de-risked way. It's a bet on the turnaround story, essentially.
A phoenix rising kind of bet, not just catching a falling knife.
You could put it that way, yeah. High risk, potentially high reward if they execute flawlessly.
Okay, definitely audacious. So wrapping this up, what we have here is a company dramatically changing its identity, shedding its old skin, going all in on fintech, credit, and this ambitious crypto play. This Q2 call really was a watershed moment for Public Square.
It truly was. The strategic thinking behind it seems clear. You can see the logic. And those operational improvements like the cost savings and the AI underwriting, they are tangible wins. But the market is asking the tough questions right now. Mainly, where does the revenue growth come from after these divestitures? How quickly can the focused fintech business ramp up to fill that gap and then accelerate?
So that September investor meeting looms large.
Absolutely critical. It's their stage to define the narrative, sell the vision, and convince investors that this transformation will work.
It definitely leaves us, and you, our listener, with a really provocative thought, doesn't it? Can a company undergo such a complete metamorphosis, even if it's well-planned and operationally sound in parts, successfully fight through that short-term market skepticism to deliver that promised long-term transformative value?
Or will the uncertainty just weigh it down until concrete proof arrives? That's the billion-dollar question, isn't it?
We will certainly be watching very closely to see how this plays out. This has been The Deep Dive. Just a reminder, everything discussed here is for informational purposes only. It's definitely not financial advice.
Please do your own research.
We really appreciate you joining us for this deep dive into Public Square's pivotal moment. We hope it gives you some food for thought as you consider these changes and what they mean for the market.